But we're seeing the impact of the Fed's recent hawkishness as rates rise and tech stocks sell off. In fact, the consensus is now for 4 rate hikes this year. And investor Bill Ackman this weekend said the Fed should consider a surprise half-point rate hike. Steve Leisman is here with more. How much more hawkish can we get at this point, Steve?
Well, you left something out, Kelly, and I'll tell you what it was in just a second. But you are right. Stronger inflation and hawkish comments from Fed officials prompting a reset in expectations for tighter interest rate policy this year. The new forecast, Kelly had it right, 4 hikes, but it's 4 hikes plus QT, quantitative tightening, and there's upside risk to that as well. A March rate hike, now it's near certainty as priced by futures markets. A second hike in June carries an 85% probability. That's according to Refinitiv. And the third hike is baked in for July or September, with strong odds of a fourth hike now in December. But that's just what's priced into rates. Fed observers also expect QT or quantitative tightening, with growing agreement the Fed will also reduce its balance sheet this year, maybe as soon as the summer. That's maybe the equivalent of another rate hike or 2. And some think the Fed on the rate side could or should do more. Goldman Sachs writing that 4 hikes plus QT may not be enough. It said in the commentary, if the FOMC wants to be a more active contributor to bringing down inflation, then it will need to do enough to tighten financial conditions materially. Some of that's happening today. To be sure, there are those who see the recent round of economic weakness and suggest that these hawkish forecasts are maybe getting ahead of themselves. But the strong trend so far has been for forecasters to raise the outlook for Fed tightening, with much depending, Kelly, on how much help the Fed gets from the market itself.
Sure, in those tightening conditions. I mean, we spoke with Dave Zervos at Jefferies last week, who said, normally we've seen even a 10 or 15% pullback engender a reaction from the Fed. All of a sudden, maybe we're down to 3 hikes or 2, or they change their tone. He said he doesn't think that's going to happen this time around, that it would take something on the range of 25 to 30% for them to change their tune.
That, I think, you could do a lot worse than get advice from David Zervos. I'll tell you that right now. And I think he's probably right. And I'll tell you why, Kelly. There's 2 things going on. The first is the Fed has to get back to where it was more or less before the pandemic, and that just goes without saying. But layer on top of that the Fed has a 7% inflation problem. So there's 2 reasons for the Fed to get where it needs to go, and that may be that it needs to sacrifice more of the market to get where it needs to go to get inflation under control. And ultimately, over time, that's better for the market than letting inflation run out of control.
That's a very interesting way of putting it, sacrificing the market to get inflation under control. Very interesting tug of war playing out here. Steve, as always, thank you. Our Steve Leisman reporting.